Welcome to Han Invest TV, where we reveal the ultimate money secrets that will completely transform your financial future starting today. Have you ever wondered why learning about personal finance suddenly changes everything about how you live, work, and plan your life? Today, we will answer the 15 most searched financial questions on Google to help you truly understand the complex money system. Many people struggle with money simply because they do not understand the hidden rules governing wealth creation and modern economic systems. Once you grasp these fundamental concepts, you will stop making costly mistakes and start building a solid foundation for lasting wealth. Let us begin with inflation, a concept that confuses many people who mistakenly believe it means prices are actually dropping down. In reality, inflation simply means that prices are rising at a slower pace than before, but they are still going up. When inflation drops from 9% to 3%, your groceries are still getting more expensive, just at a slower rate. Understanding this helps you realize why keeping all your cash under a mattress is a guaranteed way to lose purchasing power. Your money must grow faster than the inflation rate if you want to maintain your current lifestyle in the distant future. Next, let us talk about credit scores, a mysterious number that dictates your entire financial reputation in the modern banking world. Your credit score directly impacts your ability to borrow money for a house, a car, or even starting a small business. A high credit score proves to lenders that you are highly responsible, which rewards you with significantly lower interest loan rates. Conversely, a poor credit score makes borrowing extremely expensive, trapping you in a vicious cycle of high monthly payments and stress. Building good credit takes time, patience, and a proven track record of paying your bills consistently on time without missing any. Now, we must address the progressive tax system, which is arguably the most misunderstood financial concept among ordinary working-class citizens. A common myth claims that getting a raise could push you into a higher tax bracket, leaving you with less money. This is completely false, because only the income that exceeds the specific bracket threshold is taxed at that new higher rate. You will never take home less money after receiving a salary increase, so always strive to maximize your earning potential daily. Do not let financial myths hold you back from pursuing promotions, better jobs, or creating additional streams of passive income today. Moving on to investments, many people wonder why the stock market fluctuates so wildly from day to day without any warning. The stock market is driven primarily by human emotions, investor expectations, and future predictions, rather than just current company financial values. When investors feel optimistic about the future, stock prices soar, but fear and uncertainty can cause sudden drops in market value. Some critics argue that investing in the stock market is just legalized gambling, but this comparison is fundamentally flawed and inaccurate. Gambling is a zero-sum game where the house always wins, while investing allows you to own profitable, value-producing businesses. Historically, the stock market has consistently grown over long periods, rewarding patient investors who ignore short-term noise and market panic. The true secret weapon of wealth creation in the stock market is the miraculous, undeniable power of long-term compound interest. Compound interest happens when your earned interest starts earning its own interest, creating a massive snowball effect over several long decades. If you start investing early, even small amounts of money can grow into an absolute fortune by the time you retire. Time is your greatest asset when it comes to compounding, which is why starting today is better than waiting for tomorrow. To maximize this growth, you should utilize dedicated retirement accounts like the standard 401k, which offer incredible tax advantages for workers. Many employers will even match your 401k contributions, which is essentially free money added directly to your growing retirement investment portfolio. Failing to take advantage of an employer match is one of the biggest financial mistakes a young professional can ever make. Another crucial concept to master is the critical difference between good debt and bad debt in your personal wealth-building journey. Good debt is used to acquire assets that appreciate in value or generate income, like a mortgage for a rental property. Bad debt, such as high-interest credit card balances used for consumer purchases, is essentially a monthly subscription to lifelong poverty. Paying 20% on clothes and vacations will quickly drain your wealth and keep you trapped in the rat race. You must eliminate bad debt as quickly as possible before you can truly focus on building substantial, life-changing, generational wealth. Once your bad debt is cleared, you can start tracking your net worth, which is the ultimate scorecard of financial success. Your net worth is simply calculated by taking everything you own and subtracting absolutely everything that you currently owe to others. Tracking your net worth provides a clear, honest picture of your financial health and helps you make better long-term decisions. It's not about how much money you make, but rather how much money you actually keep and invest for tomorrow. Next, we need to understand the banking system and how massive financial institutions actually make billions of dollars from ordinary people. When you deposit money into a savings account, the bank doesn't just lock it away safely inside a giant vault. Instead, they lend your money out to other people for mortgages and auto loans and a significantly higher interest rate margin. They pay you a tiny fraction of a percent while charging borrowers much more, keeping the profitable difference for themselves entirely. This is why keeping all your wealth in a basic savings account benefits the bank much more than it benefits you. However, you do not need to worry about losing your deposits because of the reliable protection provided by FDIC banking insurance. The FDIC ensures that even if your bank completely collapses, your money is protected up to $250,000. Knowing this brings peace of mind, but you should still move excess cash into higher-yielding investments to fight off inflation. Let us shift our focus to the current housing market, which has become a major source of anxiety for younger generations. High interest rates and soaring property values have made buying a home incredibly difficult for the average hard-working young citizen. A significant factor driving up these housing prices is the aggressive purchasing behavior of massive corporate hedge funds and institutional investors. Hedge funds pool billions of dollars from wealthy clients to buy up single-family homes, turning them into expensive rental properties across America. This reduces the supply of available homes for regular families, driving up both purchase prices and monthly rental rates across America. While the housing market seems intimidating, understanding these macroeconomic forces helps you make smarter decisions about renting versus buying a home. Sometimes renting and investing the difference in the stock market can actually build more wealth than purchasing an overpriced suburban house. You must run the numbers carefully and avoid letting societal pressure force you into a massive mortgage you can't comfortably afford. Another vital topic is the reality of economic recessions, which often strike fear into the hearts of unprepared workers and investors. A recession is simply a normal, expected part of the economic cycle, where business activity slows and unemployment slightly rises. While recessions can be painful, they also present incredible opportunities for smart investors who have cash ready to deploy into markets. During a recession, high-quality stocks and valuable real estate often go on sale at massive, historically rare and attractive discounts. If you have a strong emergency fund and secure income, a recession is the best time to accelerate your investment strategy. This is why financial education is so empowering. It transforms fear and uncertainty into strategic confidence and long-term wealth building. Let us review the core principles we have covered so far to ensure you can apply them to your daily life. First, always protect your purchasing power by investing your money into assets that consistently outpace the silent wealth killer called inflation. Second, guard your credit score fiercely, as it is the golden key to accessing cheap capital and favorable financial loan opportunities. Third, understand that earning more money will never penalize you under the progressive tax system, so always strive for higher income. Fourth, embrace the stock market as a tool for long-term ownership of profitable businesses, not just a short-term casino. Fifth, let the magic of compound interest do the heavy lifting by starting your investment journey as early as humanly possible. Sixth, maximize your retirement accounts and never leave free employer match money on the table when setting up your workplace benefits. Seventh, aggressively eliminate bad debt from credit cards while strategically using good debt to acquire real estate and assets. Eighth, track your net worth regularly to maintain a clear, objective view of your overall financial progress and future retirement goals. Ninth, recognize that banks use your deposits to enrich themselves, so keep only your emergency fund in a standard savings account. 10th, don't rush into buying a home if the math doesn't make sense for your